Introduction. What is an interest rate and why is it important? Interest rates are an important measurement of the cost of borrowing money. It is a percentage that is applied to the amount borrowed, and it is paid back over time to the lender. The interest rate is typically applied on a per annum basis, meaning that it will be paid back in equal installments over 1 year. The resulting figure can be expressed as an annual percentage rate, APR, which includes both the interest and any other charges associated with borrowing money. The interest rate is expressed as a percentage of the amount being borrowed for a single day, for example 2% for $100 borrowed for 1 day. There are two main types of interest charges, fixed and variable. The majority of loans that people make are variable rate loans. Fixed rate loans usually have fewer fees than variable rate loans. What are current mortgage rates and the outlook for future changes? Mortgage rates have stayed below 4% since 2019 but began surging beyond that mid-March, exceeding 5% since late April. Rising inflation and the Federal Reserve's monetary policy are all putting pressure on mortgage rates. As inflation increases, the Fed reacts by applying more aggressive monetary policy, which invariably leads to higher mortgage rates. Experts are forecasting that the 30-year fixed mortgage rate will vary from 4.8% to 5.5% by the end of 2022. While mortgage rates will rise enough to discourage some refinancing, they'll remain low enough to make home buying attractive, Fratantoni says. He predicts record-breaking purchase mortgage volumes in 2022 and 2023. We're anticipating a very strong housing market, he says. How much house can you afford with different mortgage rates? The mortgage interest rate is the cost of borrowing money to purchase a home. It is usually a percentage of the loan amount and paid monthly. The lower the interest rate, the less you will pay in interest over time and the more house you can afford. Different mortgage rates will allow you to afford different types of houses. A lower interest rate will allow you to afford a larger house with a higher down payment or vice versa. The minimum down payment is the amount of money you must pay out of pocket at the time of purchase. A 10% down payment makes it possible to qualify for a lower interest rate and afford a larger, more expensive house than an 80% down payment would allow. Where can I find a mortgage rate? A mortgage company like Quicken Loans or Lending Club may offer you a mortgage rate. If not, try looking on your local bank's website. Another option is to contact your local bank's loan officer for a quote. The best way to figure out what is the best interest rate for you is to crunch. Mortgage lenders compete for your business by lowering loan costs. In the last few years, we have seen an influx of new mortgage lenders. These mortgage lenders are competing for your business by lowering loan costs. The most popular way that these mortgage lenders compete for your business is by lowering the interest rates on their loans. This is a great benefit for you because it means that you will be able to borrow more money at a lower price. These new mortgage lenders have also been competing for your business by lowering down payment requirements and closing costs. This makes it easier for you to buy a home and get your dream home without having to spend all of your savings in the process. Conclusion and additional resources. Experts' opinion on the interest rates in the future is quite positive, so it might be better to lock in a rate before it's too late. In the meantime, everyone's best guess is that interest rates next year will mirror what we see today. But experts are never perfect and they can't predict the future 100%. So who knows what might happen? It is important to remember that next year could produce different outcomes in rates, even downward movement. If you're looking to buy or refinance, now is the perfect time because low rates won't be around forever. The moral of the story? Don't put all of your eggs in one basket or take unnecessary risks based on hunches. It's important not to put all of your eggs in one basket or to take unnecessary risks on circumstantial evidence. Weigh your decision carefully and don't try to time the market. If you crunch your financials and consult closely with an experienced mortgage professional, you may be able to decide on a desirable rate lock before pulling the trigger. Introduction. What is an interest rate and why is it important?